Bitcoiners, welcome back to another episode of the Bitcoin Magazine podcast. I am joined today by Thomas Shewchuck. He's the head of underwriting at Evertas. He was formerly at Bitshure as the CEO, but I'm bringing him in now. Tom, how's it going?
Good. How are you? How's it going, Chris?
Doing well. I'm really looking forward to this interview. So I guess we'll get right into it. So Tom, you were saying, or I was going to ask you, how did you first hear about Bitcoin and what made you go down the rabbit hole and get into it?
Yeah, actually, so I was a senior at the University of Dayton, and I was studying for finals. And so me and my roommate at the time, who ended up becoming my CFO, we were sitting at the local lunch spot or breakfast spot, and there was a CNN blurb going on, and there was a chevron that said Bitcoin, new digital currency, and it was like a 2-minute thing, and I remember reading it and just thought to myself, that'll never work. And then I didn't really think about it again until like 2015. And I kind of went down the rabbit hole and did a little investigating and some guerrilla research, if you will, on Reddit. And then I started, passively investing, dollar cost averaging in around 2016. And the rest kind of snowballed from there.
Yeah, that's funny. I think we all have a very similar story. I think it was 2010 or 2011 with Laszlo with the pizza. My dad comes in the morning, and I was still living at home, and he was like, "Oh, what do you think about this guy buying pizza? Should I buy $1,000 of it?" And I was like, "Nah, it'll never work." He's like, "Yeah, you're probably right." And how foolish we were if we bought it back then. But
I know. Oh,
even
well.
I have a good feeling that even if I was like, Dad, you should definitely do it. He's very conservative in his investing. So he probably would have I'll think about it and then not done it anyway. So I don't lose too much sleep, but it is funny to sometimes back calculate how much wealth you would have had you acted on it.
Yeah, I wouldn't even know how to buy it back then, honestly. So I don't know that it would have been, even if I had investigated and been like, this sounds good, I probably would have given up at the age of 22,
Yeah,
So
definitely.
I don't know.
Well, so what made you want to get into the Bitcoin mining of it all? So you said 2015, you kind of really started to investigate it. Bitcoin mining is kind of very different than just buying Bitcoin as an investment asset. So what made you get into the Bitcoin mining business?
Yeah, so really, I wasn't really the impetus for that. It was a friend of mine who was also a business partner on another venture. He ran a fund, and I had invested in it. It was a crypto only, long denominated fund, no leverage, which ended up being its saving grace, I think, in 2018. And that went really well because his background is trading, and he saw an opportunity in kind of the ecosystem as to kind of where mining was going just in the US with our political landscape and kind of entrepreneurial spirit. And he saw it migrating away from like a cottage industry to really an industrialized industry, and he wanted to kind of be a part of it because he thought it would grow in a big way. So at the time, I was his insurance broker because that's my background. I was a broker for years, and he said, "Hey, I've got $3 million worth of equipment. Can you help me insure them?" And I said, "Sure." And so went through my back channels, Lloyd's of London, Bermuda. I work globally, so very used to all that kind of stuff. And I thought that would take maybe a month, maybe a month and a half, and it ended up taking about 5 months. And that was really eye-opening to me. And so we're talking about it, and as he got his business up and running, I kind of got a little more educated on the topics and the economics and the operations. And it's not, it's really not just you plug a bunch of computers in and you just start cash flowing. That's not really how it works. There's a lot of nuances in it, and within there's a lot of play on risk. But that from there, I really started to have an appreciation for, I think, Bitcoin as a whole, just because of how it's secured and how it's decentralized and how money, or Bitcoin rather, goes from one wallet to another. I wouldn't qualify myself as a technical expert by any means. There's people way smarter than me that would run circles around me in that regard. But I really started with an on-ramp of just passively investing in Bitcoin, and then I would say through osmosis and my friend really having an appreciation and a passion for the mining operations. And so from there, I started mining alongside him, and that's kind of how it snowballed.
Yeah, so that's awesome. What year was that when you officially, I guess you were trying to underwrite a policy for him for insurance purposes? That was 2015 or 2016, you said? And then
That was 2019 actually.
Okay.
So that was like going into the halving of 2020. So this would have been like, January or February of 2020.
Nice. And then what you eventually combined forces to kickstart Bitshure shortly afterwards?
Yeah, he he's always, very opportunistic, and it's weird. Like we work, we at the time my CFO was my college roommate, like I said before, and then he also went to my university, but he's a little younger than us, so we didn't really overlap there, and we had some mutual connections, and so we were all kind of friends through the fund and all this other stuff, and just kind of geeking about crypto. And then I also geek about insurance, and so that kind of was like not his alley, but he definitely saw the opportunity. And after talking about it, I'd say for a few months, and we got a couple other partners involved and interested, we all agreed that this might have had legs. So he just kind of trusted me, but really I was relying on his expertise at the time to kind of bridge the gap, basically. So like I can bridge the gap on the insurance side, but I needed his expertise to bridge the gap on the mining side for the things that I didn't know, because that's what he did day to day. And it was kind of this perfect amalgamation of, I think, mental capital, where you've got two parties that are trying to meet in the middle and achieve the same goal. And really that goal was to drive adoption in Bitcoin and crypto space, mainly through, building out new risk transfer solutions that were built by miners for miners. Because that was kind of one big thing that we saw as lacking in the space. Is a lot of insurance companies are opportunistic, but they don't necessarily understand the risk, but they're certainly willing to charge a high premium for it, right? So they like profits, and there was just this lack of, I think, stakeholders that were underwriting the policies that didn't actually operate the businesses, which is pretty common, I'd say, in insurance.
Yeah, so I guess that brings me kind of to, I guess, 2021 or 2022. So obviously you're helping with like underwriting policies. We saw a lot of Bitcoin miners like Compass Mining and or Core Scientific file for bankruptcy and kind of have to do reorganizations. A lot of them, it seems like they were leveraging up on their Bitcoin position, but not on the Bitcoin necessarily. Some of them did, but mainly on their ASICs. So they're using like ASIC backed collateralized loans, and they were kind of taking out more fiat to buy either more miners or open up more facilities and plants. And then obviously they understand that those assets like the ASICs depreciate over time, but I don't think they were expecting them to crash in price. I know some of my friends were looking at S19s at 14,500, 16,000 even, some of them, when then now, when the price crashed and then ultimately the ASICs followed afterwards, like, and some of the prices I was seeing for S19s or some of the top line models were around 1,800, 2,000 bucks, 2,500. So maybe can you take me through the process of like trying to underwrite it, and maybe what prevented you guys from getting into the same risks as Compass Mining and Core Scientific? I know they were running more Bitcoin operations where you guys are kind of doing the underwriting side of things, but I'd love to take you through your what the business plan was, or what everything was happening in 2021 and 2022 for you.
Yeah, really for us, we, as kind of like this expertise in underwriting in this niche market, if you will, comparatively speaking to, the slew of other things that insurance companies like to insure. We didn't have a balance sheet of, $100 million or something to go out and say, hey, we'll insure, we'll post a line of credit and we'll go out and insure, $300 million of risk. So the big issue for us was really crafting a solution to ensure these operations and the mining equipment that made sense for the miners, that covered all the things that they would want covered in the event that something went wrong, and then B, really getting it to be this very specific product that showed exactly what we were insuring and how we were charging premiums, so that we could justify things actuarially to the insurance companies that we were trying to get to back us, so we could really bring out our products in a very big way to the market. So we couldn't just write 20 policies. We could write hundreds, if not thousands, and we could insure up to tens and hundreds and billions of dollars worth of equipment. And so we figured out a way to do that, and it took us a really long time. But it was, we remember, going back to 2020, when, just before the halving or right after it, you had S9s, pallets of them going, people were saying, hey, just take them for free, just pay the shipping costs. I got to get them off my warehouse floor. They're taking up, space and collecting dust. And then if, I even remember like you could buy like, per unit, I think the most back then was maybe like $30 an S9. And then if you waited until like November of 2021, that unit was worth $700. I mean, like, quite honestly, the best trade probably wasn't buying Bitcoin at $3,800 just after before the halving, but it was buying an S9 or getting it for free and then offloading it in November of 2021. And so when you think about that dynamic, which we're very, in tune with, then you think about how an insurance policy would pay. And that was really where the issue was with us, because the machines themselves are, really valued on 3-year future cash flows. Generally speaking, there's a couple other dynamics there, but, generally speaking, that's typically how it goes. But then the insurance contracts that we have today pay out in US dollars, whereas the computers derive their revenue in terms of Bitcoin. And so you're always going to have this volatility issue in terms of price between US dollars and Bitcoin and how the mining computers are valued, because they're inextricably linked to Bitcoin, and people buy them in US dollars typically. And because our contract pays out in US dollars, you have this mechanism here where you're basically trying to bridge the gap on how to figure out how do we alleviate this market volatility issue, not just on how we're valuing these things, but how we're going to pay out for them in the event of a claim. So we figured that out, and it's brought it to market to different insurance companies, and they all thought it was fairly compelling. They thought it was fairly unique. There really wasn't anything in the market at the time like that. And then we launched everything in June of 2022 once we went through due diligence and finally got the stamp of approval from all the guys that are really, really good at math, not me, the actuaries. So worked out, and then we've been growing ever since. So it's been a unique process because there's, while there's lots of startup insurance companies out there that do this every day, there really wasn't ever one that was focused on the Bitcoin mining space. And so we think we're probably one of the best, or if not the best, at quantifying those risks. But then also thinking of our clients in that regard. And as miners ourselves, we think, all right, in this scenario, like, how would I want to do this if I were this client? And that's really the underwriting approach that we take. And then we have a conversation with them as to kind of how that solution is crafted for them and really what their goals and what they want to achieve are.
Yeah, no, I think that's awesome. I guess one thing I wanted to ask then is, when you're building out these contracts, obviously you're writing them an insurance contract for insuring a certain amount of money for the site and the machines. In the event that they default or something happens, do you guys have clauses in your contracts to take acquisition of the machines, or basically take over the facility and start running them yourselves? I know a lot of times when people are going through bankruptcies, a lot of the holdup was they were unplugging the machines or turning off the power, but it was like more beneficial to be like, all right, like, we're losing money on this asset. No one can really, we can't dump them onto the market. There's not a buyer on the other side. Let's at least, recoup our cost or maintain our cost. And I heard some companies, it went through months, and obviously the lawyers were all involved, but actually turning on the machines to help like hold the cost, or at least break even, or try and recoup something through the bankruptcies. Is there something like that for your underwriting contracts? Or you specifically do them out year to year, or do you do multi-year contracts? Obviously you either want fiat payment or Bitcoin payment or both. I'd love for you to go into the weeds there.
Yeah, the short answer is we. So first of all, the policies generally speaking are like, they're 12 months long. We have the ability to do an 18-month policy, which is really something we're trying to educate our clients on, and the brokers that we appoint to distribute our products. Because with the halving coming up, we think there may be a constriction on the availability of insurance products in the space. But if you have something that's going to take you through the halving into the Q4, Q1 of 2024, 2025, I think that's a pretty good solution, as long as it scales with you up and down, right? So, going to the halving, obviously everything's going to be should be worth less. We don't really know, but it should be, because the cash flows get cut in half for the miners. And so we make sure that the clients understand that, we can grow and shrink with you. So whatever your needs are, we want to be there to do that for you and with you. And then on the back end, we can grow with you should the values go up. But I mean, I guess we don't have any clauses in our contracts that say, like, in the event of insolvency, we take possession. That's not how that works. Just because we're really only insuring the machines and paying, our clients in the event that, there's a covered cause of loss that triggers coverage on our policy. If they go bankrupt or there is a change in control in the enterprise or the business, there's specific language around there as to how the contract would transition to the new owner, or in those scenarios, and so that how there's continuity there. But we would never take possession or repo any rigs that we're insuring, just because that's just not how the contract works.
No, that makes sense, and that's cool that you do a 12-month and even testing out 18-month contracts. I guess my next question is, what's the strategy for Bitcoin miners as hash rates ripping right now? Maybe we're going to have a little bit of a difficulty adjustment down, but it seems obviously everyone knows the halving's coming sometime in April of 2024. It appears. So obviously rigs are probably at a low price, or what we think is a low price, and shortly after the halving or around the halving, we expect the fiat price of Bitcoin to rip, and then ultimately the miners are kind of like I think a lot of people say they're a levered long, because you either get the price appreciation, like you said, probably the better trade was to buy S9s for $30 to $50 and then sell them in November of 2021 for $700, and then obviously you feel the downside when the price falls out, and then ultimately the hash rates ripping while the price is falling is never a good feeling. So what are your thoughts on that?
Well, yeah, I mean, I go through, because I mine still, that's always on my mind. So I think the key really is if you can structure, I mean, 90% of your operational expenses for any miner typically is the power costs, right? The cost of electricity. And if you can lock in long-term power costs that are, let's say below your standard market values. I mean, obviously there's an economy of scale there. The bigger you are and the more machines you have, the more power load you can command. I think that's point number one, is really, if you're a miner, you're trying to always get your costs in check, because while your revenue is in typically Bitcoin, your costs are typically fixed in US dollars. And so unless you're beholden to variable power costs, depending on your power purchasing agreements or your structures that you have with your colos, if you can lock in just a fixed power rate that's low enough where you've modeled like, okay, even if, my cash flow gets cut in half and Bitcoin drops to say 12,000, I can still operate, or maybe you plan for that scenario. Typically my strategy, which has worked in the last halving, my strategy was basically to just build up a war chest of like roughly 6 to 10 months of OpEx, capital, just to pay my monthly overhead, and then basically mine through the halving or when my margins are getting crushed, mainly because, right now is the time you really want to be mining before those block rewards get cut in half. My goal is to accumulate as much Satoshis as possible. And I think that's typically what most miners think. Now, I think public miners have, I think generally they're in the same vein, but, obviously they have investors and public markets and regulators to appease. So they may have a little bit of a different strategy, but, I think it starts with margins, and then you work your way backwards from that. And there's usually a few ways you can gain more margin to make sure you're still profitable and you can still mine through the halving. One is minimizing your overhead costs, your monthly expense. Two is looking at ways to upgrade the efficiency of your fleet, whether that's through liquid immersion if you're in ambient air. Perhaps that's, buying the newer gen equipment, which, typically your dollar goes a lot further today in buying the new equipment than it did, I'd say 6, 7, 8 months ago. So if you have some dry powder, now is not a bad time to deploy. And then, from there, you basically just have to figure out what is the long-term strategy over the next 5 years, I would say, that takes you through the halving going into the next one in 2028. So it's also a moving target, because you do have, well, the halving's like this clear cut event, what's going to happen there. You don't really know how to model the mining difficulty on the network. I mean, I didn't think we'd be at, I mean, I think we're probably going to be close to 450, maybe even close to 500 exahash by at some point in the next 6 to 12 months. I mean, I could be off base there, but I didn't think we get to 400 as quick as we did. And now I'm wondering if my initial estimations are even, lower than what I previously had thought. So it's this thing you got to always look at. And there's not really a right answer, but I think if you can keep the cost in check and make sure that you're managing your treasury in a proper manner, it's probably the right way to go. I remember talking to gosh, this was like July of last year before really everything went to go sideways, and we were talking to a pretty big miner. I won't say who it is, but their entire finance team had not modeled Bitcoin below 30,000 ever again. And I just kind of looked at them and I said, well, you may not, think that it's going there, but you certainly have modeled for it because you have a very large enterprise that you have to kind of manage. And they said, no, we just don't think it's going to happen. And, it's not something that we're really entertaining. And I just thought that was very bold. But I'm in insurance, so I'm more risk averse than most.
Yeah.
I'm a little different.
Yeah, no, that's pretty crazy that they didn't model it. I mean, I know a lot of people were expecting the cycle of, never falling below the old previous all-time high, and then obviously that model was broken too when we broke to like 15.5. But yeah, that's very interesting and bold to say that we're never falling below 30K. But I guess all models are destroyed with Bitcoin. So
Yeah.
I guess my question then is, I think that's a good point that you say that you're always trying to control your costs. And it seems that as the newer gen machines are coming out, I know in the beginning of Bitcoin, machines could be dead or not viable, or cost efficient after 6 months, 12 months, 18 months. It seems like obviously right now the S9 came out in what, 2016, 2017. So it's been like a 7-year model, which has shown that it's really a beast and really a truly an awesome machine. And it also seems that like we're basically reaching the marginal cost of production for the chips. Like they can only get so small. I think right now 3 nanometer are the smallest, and if you start getting any smaller than that, like you can break the chip because that you're basically hitting up against the laws of physics in terms of like atoms and the molecules that are actually taking place on the chip. So it does seem like the only thing that you can really control is, aside from the cost of the machines and getting them at a fair market or what you believe to be a fair market, is controlling your cost of electricity. Obviously, everyone could be profitable if their electricity was free. So it does seem like there is a race to try and get basically free energy or near free energy in order to prop up the Bitcoin mining side of the business.
Mm-hmm.
Yeah, I don't know if there's anything that you want to add there, or we can start to talk about the acquisition of Bitshure and Evertas.
One thing I'd add is, I think long term, if you think about really, in my opinion, and I'm not, there's more than one strategy here, but I think if the biggest issue for miners is really you can't control the halving, you can't control mining difficulty, but what you can control is your own, enterprise costs. I think with that in mind, really that's the main variable that's within everyone's control. And I think that really, I suspect that in the next 10 years, who really knows what we're going to be, but I would not be surprised if we saw the largest miners in the world are not really the miners we see today. I think they're probably going to be energy producers. Why? Because they're producing energy, and if you can, especially with stranded assets like flare gas or solar and wind, or places where it's just uneconomical to actually port that energy elsewhere to be refined. I just think that they've got all these liabilities on their balance sheet, and you're telling them that, hey, you can convert these to cash flowing assets with Bitcoin mining for relatively low startup costs. I think that's going to make a ton of sense to them. And I think they're probably going to be the biggest miners when it's all said and done, maybe mainly because they can operate at near zero operating expense and energy costs because they already control the means of production for that. I just think that makes a ton of sense, but who really knows? I don't, I'd love to see everybody mining at some point. Still, I'd like to still be mining in 10 years. That'd be nice, but we'll see.
Yeah, and that's funny you should bring that up. I have a couple friends that like saying that Bitcoin miners were going to buy like oil and gas companies one day, and maybe I was just bearish on Bitcoin miners. And this is back when we thought we were going to 100K, but I'm like,
Yeah.
I think any oil and gas producer is going to see this and want to gobble this up. I mean, their balance sheets are obviously much larger than even the largest Bitcoin miners in the space. And to
Yeah.
your point, engineering is my previous background and degree. And you're always looking to turn waste byproducts or waste products into profitable revenue streams. And
Mm-hmm.
oil and gas, like if they're doing stranded energy, whether it's methane gas coming off of their rigs or their operations, normally they're fined for the EPA or the whatever the regulatory body is, the state. They normally have to pay costs for the amount of flared gas that they have, and or pay fines and or stop production if the emissions get too much. It's a no-brainer to put
Oh yeah.
capture the gas and use that for basically profiting and propping up Bitcoin miners. So
Oh yeah, we're already seeing it on our end with the submission flow that we're getting there. And even though it may feel like to the average retail investor that this is still very much a bear market, I've seen more growth in the mining space in the last 6 months than I did all of 2022. And I think a lot of that had to do with supply chain disruptions, which I think have been rectified today. But I see a lot of new players that are allocating capital, building out their facilities, buying more machines because, they're all relatively cheap, comparatively speaking. But, I also think it's really unique that we see this pretty interesting shift to joint ventures on the solar and wind power generation side. I mean, if you think about it, it's pretty unique that you have some sort of monetary system that can be built on renewable or sustainable energy, and Bitcoin really is just it's decentralized sovereign money that's essentially secured by energy. That's really what it is, in my opinion. And when you have these massive solar farms where financially it's relatively difficult to model, how much energy you're going to produce and whether or not that's going to be profitable depending on when you produce it, because you don't necessarily know if that's going to line up with when the grid needs the power and when you can sell it back and what dollar amount you're going to be able to sell it for. These solar and wind farms are using miners as basically this anchor tenant because they require power loads 24/7 and it's constant, right? So you get these guys that build out sites, I'm not going to name names, but there's a pretty big company that just did one and we looked at insuring a client there, and essentially they're basically operating all of their monthly overhead on selling the power to the Bitcoin miner, and then basically they're making all their margin on selling to the grid when they have excess power. And the miners love it because they're buying power at, say, 3, 4 cents, maybe sometimes even lower, like 1.5, maybe 2 cents a kilowatt hour, which is perfect going into halving. But it's like I always cringe when I read these headlines that Bitcoin isn't green, because it's like if you knew the economics of sustainable and green energy, I mean, Bitcoin just makes that equation make way more sense. It makes it commercially viable, in my humble opinion. I'm not an economist or a financial analyst by any means, but from what I can see, money usually travels the path of least resistance. And, I think if you are, some sort of environmentalist, or you're really looking to make a change with how you use energy or what sources of energy you're using, I think Bitcoin can be a great gateway to those other avenues.
Yeah, no, I completely agree. We've got great writers or op-ed writers for Bitcoin Magazine: Margot Paez, Troy Cross, and Daniel Batten. Daniel Batten was like, he even says, he's like, I was a hardcore Greenpeace kind of guy. Like he invested or gave money to the nonprofit. And then when he started looking into Bitcoin mining, he definitely flipped the narrative and all that. And he actually combats a lot of the arguments that they say it's not good for the environment. He even compares like Bitcoin mining is the most sustainable business in the world, bar none, comparing Tesla, comparing oil and gas, comparing wind farms. And he gets really into the mass and energy balances of both, basically saying like, oh yeah, like you can say Tesla's nice, but like the cobalt's got to come out of the ground at some point to make these batteries, or the lithium needs to come out of the ground to make these batteries. So he compares even like not to say environmental damage, but the environmental impact of these businesses. And Bitcoin mining, like you said, you're kind of bootstrapping on solar and wind farms, and you can make them economically viable. I know a lot of them in the last 10 to 15 years were very lucky with tax breaks and tax incentives, and that could bootstrap it. Like you get this huge government tax incentive to open it, but Bitcoin miners can strap onto them to really make them economically profitable and make them good for the long term, especially now as some of those tax incentives have expired or much
Yeah.
lower than they were.
Yeah, and mining's mobile too, so you're not constrained by geographies really. It's like if you want to set up a wind or a solar farm, you can do so really wherever. Obviously, you've got to build out the infrastructure for all the power generation, but if you're talking about, hey, wooing some sort of business like a miner to come out and say, hey, I've got this source of energy. I'd love to sell it to you. Come on site and take a look. They'll do that all day. I mean, it doesn't really matter where you mine, and we're cognizant of that. And so we like those opportunities when they need insurance.
Yeah, definitely. I mean, even look at it, not even just like a year and a half ago with Texas with the grid when they had that huge ice storm. And basically, they were worried about needing more power. And they were kind of showing that prices were going to spike because a lot of plants or power lines were going down and they needed more power back. The miner that's in Texas was able to turn off their machines, even to like perfectly too, in the sense that like the miner, the power company was calling the miner like, "Hey, are you going to turn off?" And right as the price was like starting to peak, then they were turning off and giving load back to it. And basically, it's truly an engineering feat and truly incredible. Obviously, they had a little bit of incentive there with ERGOT in order to they get incentivized to turn off and they get
Yep.
basically paid to do so. But yeah, I mean,
Yeah.
it's making it economically viable and kind of on the free and open market, which is really really cool.
Mhm.
I guess transitioning more from the Bitcoining mining side of things, even though I could talk about that for a while. So I guess what was the motivation for Bitshure to get acquired or sell them to Evertas? I know that you said you guys were working very hard and basically got rubber stamped in 2022, only for just a month or two ago or a month and a half ago in July for you guys to sell or get acquired by Evertas. What was the logic between you and your co-founders with doing that?
Yeah, it was honestly it was not really I wouldn't say a difficult decision. We've known the folks at Evertas, Jared and Raymond, who founded the company. I've known them for about 4 or 5 years now, and as you can imagine, insurance and anything related to the crypto space is a pretty small sphere. So you end up rubbing elbows with each other at some point. So we had already started working together with them as kind of on a consulting basis, essentially, as underwriters, because they had the ability to insure computers, which were much larger abilities than us, roughly 20 times the amount that we could do. And so that was very meaningful for us because we said, well, they didn't have an underwriting expertise on the property side for the mining space. We did. They had the ability to insure up to $200 million worth of equipment. We did not. And that was basically the first synergy that we aligned and said, look, let's work together here and we'll kind of split the profits if we can. And, we'll see how that goes. And, that was a pretty basic trial run, I'd say, of a few months that we started to realize on both sides very quickly that A, we work really well together. B, there's just way more synergies than just this one little item that we're actually working on. And C, we really wanted to figure out what it would look like if we combined forces. And so there was, like any acquisition, there's a song and dance. And once we hammered out the larger items of the details, we tried to streamline as much as we could. But we initially, we initially didn't really think about it. It was more or less just this, I would say this good partnership that worked out for both parties. It was perfect. And then we just kind of, we were on a call one day and I think, I might've said it or Jared would have said it. And I said, well, what about a merger? And we all just kind of thought about it and we were like, yeah, that actually would make a lot of sense. And so now I can confidently say being, after the close and being in for a couple months now, things have been going better than I thought they would. So we've been very pleased with the move. I know I can't speak for Jared and Raymond themselves, but I know that everybody at Evertas is pleased with having me and my team over there. And we're really excited for what's going to happen in the future. And we're just getting started.
Yeah, no, that's awesome. And that actually kind of leads me into my last and final point. I guess, what do you think the future is of Bitcoin mining or maybe even Bitcoin products in general? I know there's, one of my buddies runs Anchor Watch insurance, which trying to insure people's Bitcoin for loss, with hardware wallets and stuff. Obviously, you guys are insuring the mining side of things. I'm sure other insurance products are going to pop up along the way of, maybe insuring your phones or, hot wallets, or I'm not kind of sure what other insurance products, but what do you see the insurance market for Bitcoin and insurance combining together in the future look like?
So that's kind of the unique thing about Evertas is now, Bitshure was we founded that with the focus of the Bitcoin mining property and that space, right? We weren't really focused on digital asset theft or, loss of funds via transmittal or a DeFi issue, like a slashing event or something like that. So Evertas, that's what their focus is. So when they started, they went after, or they were trying to create a better product and risk transfer solution for custodians and non-custodians that handle Bitcoin or clients' funds and all that. And so they did that in a really big way. And then they were able to secure they have the largest ability, to my knowledge, and I'm pretty knowledgeable about the insurance space, of any other insurer in the world. So they can put up $420 million of coverage for any one custodian. So if you're like a Coinbase or a Robinhood and you want to insure your digital assets, I think Robinhood, I read on CoinDesk, has like a $3 billion liability essentially in terms of the Bitcoin that they hold. Any one insurer besides Evertas can maybe get to like, 50 to 100 million, generally speaking. Beyond that, it's a much more, I would say, quilted or stitched together solution. I won't go into the details because insurance can be boring, so I won't. But Evertas, I'm the head of underwriting over there, but we can do literally just one underwriter can do $420 million, which is roughly 4 times what anybody else can in the space. And that's pretty new as of, I think we announced that in July or June of this year. And then couple that with the fact that when they were doing that, they said, look, can we also do the property side? And we can do $200 million over there. And they said, yeah, sure, no problem. We can do that. And, it was, that was obviously one of the reasons Bitshure came over. So my focus has been, how do we put on good risk on the books and then really deploy essentially the coverage limits that we want to out to the marketplace that sorely needs it. And, I think we've been doing that in a really good way so far, but we're looking to build that out above 420 million and above 200 million. I want to get to roughly 400 to 500 million on the property side, and probably, I don't want to say the B word, but billion on the custody side if we can. So that's the first part that I want to kind of look at. And we're actively sourcing solutions there. I'll be in London in September, doing just that. And then the other part is really developing new products for a space that really hasn't had much insurance innovation. So, you have to think about like traditional insurance companies, they know property like brick and mortar stores, or like, insuring a main street in Hawaii, like Lahaina. And, when something happens that catastrophically just ruins their financial modeling on their insurance products, they really don't want to expand in other areas that they don't know much about. Why? Because there's just not much data out there where they can reasonably say, hey, we're going to be within 2% of a margin of error and profitable here. They're having enough time in their vanilla and core business to do that. So what we're doing is we're kind of looking at that as kind of an opportunity for us to say, look, no one else really wants, everyone's running away from crypto right now. We're the only ones either standing in the street saying, hey, we're still here, or running towards the opportunity. So one of the big things we're going to develop here, and we're hoping to launch pretty soon, is going to be direct with officers insurance for private companies. So that not just miners, but everybody that has in the crypto or blockchain space or is crypto adjacent. Maybe you're a hedge fund and now you've got some sort of crypto exposure because you've ventured into those alternative assets, and your insurance company saying, hey, we're not going to cover you for anything arising out of, the loss or theft of a digital asset, right? Which is, that's pretty detrimental, I'd say, especially if you're a new business that's just trying to get into the space in an emerging market. So we want to help there. So that's one thing that we're going to do. Another one on the mining side is really going to be this, I don't want to call it a warranty product because it is and it isn't, but really around the mining computers themselves and the loss of production, essentially. So in essence, like we would repair the machines should they go down due to like an equipment breakdown loss or event, as long as they're outside of the product, like the manufacturer's warranty on that. We're still developing the language there, but I'm pretty excited to. I can't really say much right now because it's still proprietary, but I'm pretty excited to launch that in the next 6 to 12 months. And then the final thing was really, I think we have so much opportunity around other areas like cyber liability and technology whereby you have, a lot of different companies that have a lot of different risks that are not adequately addressed or even just specifically excluded by the current markets that insure them. And so we want to basically help on all those fronts with our existing products. So we're about to launch a revamp of Evertas's new policy form, and it's pretty exciting because it does all the things that basically where the insurance market is inefficient in crypto today. That's where we're going to start being efficient. So I'm very excited for all that.
Yeah, that's awesome. And I know when I was talking to your colleagues, they were saying it's 200 million insurance per property. So I was like, a lot of the Bitcoin miners are probably, their market caps are much larger than that. So you're not able to insure the whole company, but they're like, but it's a site by site cases, and 200 million is probably a pretty good estimate for even some of the biggest sites in North America.
So that's actually kind of where the bear market has really helped us, is because while the dollar values of the equipment is depressed, that has allowed our $200 million coverage limit for the ASICs to really be very efficient, right? So we can scale it much further than we could, say, back in November of 2021 when everything was valued at 10,000 a unit. And so obviously we're aware of the cycles. We know the clients that we have today. We have some very large public companies. We have some very large private miners. We know exactly where we think their miner values are going to go and what that dollar amount looks like on an aggregate basis, on a per location or per site basis. So we're actively sourcing solutions for that. I think we'll get there. That's probably a 2025 issue or a Q4 of 2024 issue. But we're not resting on our laurels right now. We understand that's going to be a big bottleneck, and we want to be the market essentially to say, look, if you have need for 400 million or 500 million or 600 million, you don't have to go out and buy another policy that attaches above us. We can just scale the solution. So you don't have to worry about, like, am I going to be able to insure my assets? We want to be that one-stop shop for everyone in that scalable solution, where, so that you can basically just manage your enterprise risk without having to worry about it. Plus, the public companies have a lot of constraints around them, especially from compliance and oversight. And I think it's just one of those extra things that's really needed when we see what the market looks like post halving in 2024.
Yeah, Tom, thank you so much. This has been a great interview. Is there any last words that you want to say to basically our listeners? What would you like to say, or where would you like to leave them?
Evertas.com. Go there if you have any questions. Email info@evertas.com. We're not a big team, but I love educating and helping people however we can. And if you don't have a broker, we can certainly steer you in the right direction to a good one. And I really appreciate you having me on. And if you ever want to talk insurance again, although I doubt it, I'm happy to come on again.
No, I'd love to have you back again. So, Tom, thank you so much. Everyone, thank you for listening to the Bitcoin Magazine podcast. As you know, you can go to b.tc/conference to get your tickets for Bitcoin Amsterdam. That's coming up October 12th through the 13th. Or you can get tickets to Nashville, or to Bitcoin 2020 Nashville, July 25th through the 27th. Thanks, everyone, for listening. Have a good one. Peace.
Thank you, Miami, for the last 3 years in this amazing city. The whole world shut down, but Miami welcomed us with open arms. We want to show Bitcoin to the whole world. We are taking the conference on the road to set the stage for Bitcoin in a new city. Nashville. Bitcoin 2024 is coming to Nashville in Tennessee, a city that is known as a music and freedom city. Bitcoin 2024 in Nashville from July 25th to 27th.